Hello, welcome to AleaSoft webinar. My name is Alejandro Delgado, Technical Director of AleaSoft and Associate Partner of Alea Green, and thank you for joining us today to the webinar with the topic Prospect for the Energy Markets in Europe, Vision of the Future of the Energy Storage. Our first speaker today will be Oriol Saltó, Data Analysis and Modeling Director of AleaSoft and Associate Partner of Alea Green, that will analyze the evolution of the European energy markets. Then, we are sharing this webinar again with Tomás García, Senior Director, Energy and Infrastructure Advisory at JLL, that will talk about the Spanish storage market, context and trends, and best revenue stack, technical aspects, and financing considerations. If you have any questions at any time during the webinar, please use the Q&A menu, and we will answer them after the presentations. And now, I hope you enjoyed the webinar. Oriol, please share your slides.
Good morning, everybody. Thank you, Alejandro. And okay, I will start. As Alejandro mentioned, I will cover the first part, talking about the European energy markets, how they've been developing during these last weeks. We will compare the situation with the one that we showed in our last webinar. It was in mid-January. And okay, let's just start right away. As always, I start with a brief description of the company AleaSoft and the services that we offer in case you don't know us. In AleaSoft, we offer forecasting services for the energy sector. We cover all the energy markets in Europe, and we are also covering some energy markets in South America, also in North America. So briefly, we will update this map because it's getting a bit older. Now we are covering also markets, as I mentioned, in America. We will start covering markets in Asia also, and our goal is to cover all the energy markets at the global level. We basically offer forecasting services for any variable that it's interesting for the energy sector. Obviously, demand and price of gas and electricity markets, but also not only forecast for the spot market or the day-ahead markets, but also in balance services, intraday markets, etc. Also futures markets. So any market and any variable needed and related in the energy sector. Also, obviously, forecasting renewable production, also fuel prices like oil and CO2 prices, socioeconomic indexes, weather data, anything related and with the energy sector, and anything that can impact one way or another in the energy markets. And not also, let's say, deterministic forecast, but we also provide simulations. We can provide hourly price simulations for the long term, very useful, for instance, for batteries when designing an energy storage system. Having hourly price simulation, it's very useful in order to forecast your possible revenues, also trying to correctly dimension your installation, very useful. And basically, we have as our customers any player, any actor that plays a role in the energy sector. We have customers in the side of the consumption, the side of the generation, also in system operators, and also obviously traders, sponsors for renewable energy projects, banks, investment funds, etc. And the forecasting methodology that we use is a methodology that we developed ourselves. The three main points that we always like to stress about this methodology is that it is a completely scientifically based methodology developed specifically for forecasting in the energy sector. This scientific base of the forecasting methodology provides consistent and coherent forecast. Our forecast keep consistency from one delivery to the next. This coherency of our forecast a long time is one of the main aspects that our clients like about our forecasting reports. And well, this is the methodology that we have been using for 25 years now. This year we are celebrating the 25th anniversary of the company. So we started in the Iberian electricity market, and now we are covering, as I mentioned, all the European energy markets and also some markets in South and North America. And well, we started as a company forecasting demand, then forecasting prices. But basically, as we are growing and along these 25 years of history, we have basically started to cover all aspects and needs of our customers. So not only forecasting services, also consultancy services, even law reports. Basically, any need that a customer in the energy sector needs, we are basically able to cover them, because usually some people know us because of our forecasting services, others for our consultancy, and we offer a very wide range of services for the energy sector. One of the services that we are providing is that we can act as market integrators, because, well, organically these services, this kind of services grow because, as we have, as I mentioned, customers from all the sides: production, consumption, investment. So all the sides of a renewable energy project, we basically can act as a market integrator. So we offer services for market integrators for PPAs. So we have kind of a hub among all our customers. So if we can find an off-taker for a PPA for a project, for a PPA, or if one off-taker is looking for a PPA with a production plant, we can also try to match. This is a services that is growing rapidly in these last years, and we can also act as market integrators for parties buying and selling renewable energy projects. So, as always, I start with the fuel prices. We always start with oil prices. And if we look at the evolution of the Brent oil prices during the last weeks, we see that since the beginning of the year, after reaching this local minimum around 70 something, below $75 per barrel, the trend has been clearly of rising prices. Why these rising prices? Well, as we mentioned in previous webinars, from the demand side, demand is growing much slower than expected. So basically, on the production side, they have been announcing and trying to adjust the production in order for prices not to go too low. So basically, this increase in prices recently are basically driven by the cuts on the production side, or just the announcement of future production cuts, basically pushing prices up a little bit. How far can these prices go up? Well, it's difficult to say, but it looks like it's difficult for this rising trend to keep for much longer, because, as I mentioned, from the demand side, demand is not growing as expected. And on the production side, basically all the cuts in production that can be done are already in place. For one of the main producers, Saudi, Arabic Saudi, they basically are producing just 3/4 of all of their capacity. So basically, no further cuts are realistic. And this is on the OPEC plus countries, because the rest of the countries, mainly in the United States and Latin America, South America, basically they have been increasing production. So it's difficult for this trend of rising prices to keep for much longer. It is not. It probably won't reach the $90 per barrel. This is not very realistically. So probably the most probable trend for the following weeks and months is basically prices within this range of $75-$85 per barrel. On the other hand, on the gas prices, well, since the beginning of the last quarter of 2023, we have seen how prices are steady and are consistently going down in Europe and also in other markets. This is basically because, well, in Europe we have a reliable amount of stored gas. Also, the weather. We had some very cold weather at the very beginning of the year, but as the storage gas levels are still quite full for the time of the year that we are right now, and basically as there is we have enough gas, and even some disruptions on the global supply of LNG don't look to be affecting the gas prices. So basically everything looks relatively quiet, so prices are going down. We are reaching the level of 25 euros megawatt hour. Some of the last minimums were at this level. We are still a little bit far of the historical average. That is below 20 euros megawatt hour. We will afterwards see how the futures for the following years look like, but basically it looks that this 25 euros megawatt hour is more or less the new equilibrium price. So it looks like prices may still go down a little bit, but it looks like this around 25, it's the price that they are going to be. And they still exist some risk of spikes in the price until the end of the winter, but they are relatively with very low probability. I would say it's difficult that we will see again this winter prices like the ones that we see in 2022. Probably, maybe some new heights, but not at that level. So, and as we will see afterwards with the storage capacity, we are facing the refilling period until the next winter with relative stability. If we look at how the gas demand in Europe behaved in January, we had again double digits rise around 12%, 12-13%, basically driven by the consumption in industry that it's again increasing. It has been increasing during the last part of 2023. It keeps increasing in 2024. Also in the residential and commercial sectors, due to as I mentioned, the cold weather at the beginning of the year, so an increase. And also this increase in the gas demand for heating also brought an increase in the electricity demand, also partly for heating. So the gas used in the electricity production also increased a little bit. That it's been decreasing for most of 2022 and 2023. Also some base effect, because in January 2023 we had an important decrease in the gas demand. So now so some base effects coming from very low values, important increase in January. The levels of the gas storage right now, they are at 67%. We are already about to leave the heating season. So basically, probably by the end of the winter, they won't go below 50%. So more or less the same levels and situation that we were 1 year ago. So basically, as we will start the refilling season, it looks quite good with high levels of gas storage and low prices. So it gives a very good perspective for the following winter. On the CO2, well, as we have been seeing for 12 months, prices have been decreasing. Recently, this price drop increased a little bit. Since 12 months ago, prices went down by 44%, nearly half of what we had in the peak of the energy price crisis. In fact, this is the lowest price since the October 2021. So it's difficult to say how much low they can go before resuming the upward trend that historically is expected for the CO2 emission prices. So if we make a little of a zoom out and we look at the historical perspective of these prices, we see that historically they have been around 10, 25, even 5 euros per ton. And then in 2018, they started increasing. And then during these gas prices, they increased. So as I mentioned, now we are at the level of prices of 2021. If they go lower than that, maybe they can go down to the prices that we had in 2019, 2020, around 20, 30 euros per ton. But it's difficult to say. So if we consider these prices during 2022 and 2023 as a kind of anomaly in the behavior of these prices, the historical trend of increasing prices, it may indicate that maybe this is the time that prices will stop dropping and will start increasing again. But it's difficult to say. This market, it's so with very low gas prices, it kind of incentivizes a little bit the production of the production with gas, so people don't care about spending CO2 if also they go down. So it's difficult to say, but maybe we are reaching the point where prices will stop dropping and start increasing again. We will see. Now, about the evolution of electricity market prices, we will see this in our online data platform. This is one of the services that we provide to our customers. We have an energy database, basically with all the electricity markets, all the futures markets, also with macroeconomic data, basically all the data needed by any player in the energy sector, being data analyst, traders, investors, journalists, CEOs, CFOs, etc. So anyone will benefit from having all the data needed in a reliable source, always updated, always with the same format, easy to download, easy to analyze, so very convenient. So this is the monthly average prices for some of the most important electricity markets in Europe: Spain, France, Germany, UK, Italy, Netherlands, etc. If we look at the last full month that we had, it was January. So in January, prices were around high 70s for most of the markets. Italy, it's the most expensive market, usually around 100 euros per megawatt hour. So compared to December, that was the last full month that we saw in our last webinar, Italy went down by 14%, then France, Germany, and Belgium went up around 13%. Spain increased a little bit, just 3%, and UK also a little bit, 4%. If we look at, we make a zoom of the daily averages for the last weeks. This is since the beginning of December, and we basically saw obviously fluctuating prices, but we saw a general trend of decreasing prices, following mainly the evolution of gas prices that we have just seen. And if we look now at the hourly prices, this is since the beginning of this month of February. So basically we have half a month, and well, we basically, as always, Italy these markets that are heavily coupled. And now I would like to focus in this episode of in this episode of low prices that we saw in the Iberian market in Spain. That is, this is the one in blue. When last weekend we had zero prices. Those were the first zero prices that we had in this 2024. And as you see, they were kind of isolated from the rest of the markets. So basically, we only had very low prices in Spain. And this is very related with the wind energy. So if we are seeing here the market prices for Spain in blue, wind energy production in red, and in yellow we see the nuclear production. So first interesting thing to see is how these very low prices these days, with very low prices, both in the beginning of January, the beginning of January, in mid-January, and now this last weekend, are clearly related with episodes of very high wind production. And not only this, if you see here, you see decreases in the nuclear production. Nuclear production in Spain, we have 7 reactors. It's pretty steady. So basically the only variations in nuclear production are related to scheduled downtimes for refueling, for maintenance. But these episodes corresponding or linked with very high wind energy production days here and here are reduce its power. It may look small, but some of the nuclear reactors reduced their power by 33%. So something that had happened in the past and something that we may see in the future. Okay, going back now to my slides. Let me see if I find, okay, here. Basically, as I mentioned, now how another way to see this decrease in electricity prices that we are seeing right now, coming from the prices that we have during the energy crisis in 2022. This is the monthly average for the Iberian electricity market. We can interpret this behavior as this price drop as a return to the long-term equilibrium of this market. So this is in blue here, you see one long-term forecast that we did back in October 2010, so 13 years ago. And basically this long-term forecast is describing what at that time we saw as the price equilibrium at the long term. And we see basically that the prices have been following this, have been fluctuating around these equilibrium prices that we projected at that time. And right now prices are coming back to that levels coming from the very high prices. So with this long-term forecast that we did at that time, we can interpret that right now prices are coming back and they are already more or less at the long-term price equilibrium that we were projecting at that time. Okay, as I mentioned, we are providing a lot of different services in our website. You can find all the reports and services that we provide that go much beyond just the forecasting. Okay, now let's take a look at the futures markets. So what the market agents are seeing right now about the energy that is going to be delivered into the future. This is the forward curve for the Brent oil. And it is compared to the forward curve that we see 4 weeks ago in our last webinar in January. Basically, as spot prices has been increasing, we saw some increase at the beginning of the curve, more or less 5% in 2024, 3.4% for 2025, and a slight increase around 3% in the rest of the curve. But basically, long-term equilibrium prices are still around $70 per barrel. Very different situation in the forward curve for the TTF gas. So we have been seeing webinar after webinar how prices have been falling, and they are still falling. So compared to our last webinar 4 weeks ago, in just 4 weeks, for the rest of 2024, futures went down by 13%, for 2025, 12%, 8% for 2026. So futures prices decreasing at a relatively very high rate. So we are still, as we saw when we saw the spot prices, far from the historical average. But looking at the futures, at the forward curve, it looks like the new long-term equilibrium price, it's going to be more or less around this 25 euros megawatt hour. So we will see if prices can go down much below this 25 euros megawatt hour. And this, as we will see, have had a very huge impact on the electricity futures that we will see later. And the forward curve for the CO2 prices, basically following the decrease in the spot prices, all futures for all maturities went down by 13%. And now the futures for electricity, following the decrease in futures for gas, huge drops in all maturities. So between 8 and 13% for Cal 25, 10-15% for Cal 26. Even some markets like Spain and Germany had decreases of 16%. This is just in 4 weeks. So in 4 weeks, prices for 2034, so in 10 years, have been decreasing 16%. This is also a warning when you are trying to correctly interpret this forward curve. So these are very illiquid markets at this very long term. So it's a little bit dangerous to use this forward curve just as a forecast for futures prices, for prices in the future, for spot prices in the future. So a little warning on this note. And as I mentioned, that the main driver for this decrease in electricity futures are the decrease in gas futures. Just as a fast comparison between futures, how being the futures for gas and electricity have been comparing for last week. So here we are comparing Cal 25 Spanish power futures with the TTF gas futures for January 2025. And basically you see how they are very correlated. So as I mentioned, one of the main drivers for this decrease in electricity futures are the decrease in the gas in the prices for gas futures. In this period, that is since basically the beginning of the year, electricity prices went down 21%, gas prices 23%. So as you can see, very correlated. And okay, I'm reaching the end of the slides. Just as what are the key elements that we are taking now when doing our forecast? Also as a summary, that what we have been seeing. Brent oil prices, an upward trend since the beginning of the year. As the demand is not growing as expected, and basically all the cuts in production are already in place, it's difficult that this trend will continue in the following weeks. Natural gas prices keep going down, reaching now the 25 euros megawatt hour. It's an important psychological level because it's where the futures at the long terms are, and it's also one of the previous minimums and maximums that we saw in the historical series. So important to see what will happen once we completely reach this 25 euros megawatt hour. CO2 prices, on the other hand, difficult to see when they will start recovering and summarizing the historical upwards trend. Right now, around 50 euros per ton. And we have seen how electricity futures have been also going down, very correlated with a decrease in gas futures. And at the long term was basically no changes of how we are seeing prices at the very long term will be driven basically by the renewable energy production of green hydrogen, everything combined with battery storage that we will talk now about battery storage and energy storage, and also how the hybridization of all these technologies, storage, renewable energy, green hydrogen production, how the hybridization of all these technologies will play a key role in the market prices in the future. So that's all. Just let me invite you to our next webinar. It's going to be in March the 14th, and we will again be collaborating with EY. I think it's going to be the fourth year in a row, collaborating with EY, talking about regulations, PPAs, green hydrogen, everything related with renewable energies, energy transition, green hydrogen, etc. So thank you, Alejandro.
Thank you very much, Oriol. Very detailed presentation as usual. And thank you, Tomás, for joining us again in our monthly webinars. And when you're ready, you can change your slides now.
Hi, good morning, everyone. Yeah, let me share my screen. So hopefully you can see that now in full screen.
Yes, it's great.
All right, so good morning, everyone. Apologies for connecting a little bit late. Murphy's law. I had some technical issues, but happily it's resolved. Thank you very much to AleaSoft, to Antonio, for inviting us once again to do this very interesting webinar series. So we're here to talk about the storage market in Spain, battery markets in Spain. It's a subject that is actually attracting lots of attention from all kinds of players in the renewable energy industry, investors, developers, IPPs, oil majors. Everyone is kind of looking into battery storage and also hybridizing their existing either wind or solar PV plants with storage facilities. So my presentation is gonna verse more around standalone storage, a different kind of animal, as we will see in a second. So let me take you through that. This is the agenda for today. I will just briefly mention who we are at JLL. By the way, I'm one of the senior directors at JLL, leading the Spanish and Portuguese business based here in Madrid. Then we will set the scene for the Spanish battery storage market. So provide some context and market trends that we are observing. Then we will dive into the revenue stack, which is actually the name of the game. Everything kind of depends on the future revenues that these storage facilities will be able to generate in the medium to long term. We're not technical advisors, but let us highlight a number of technical aspects that I think are quite important to keep in mind. And also some financing considerations. There is lots of discussion around how these projects might be able to finance in the future. So we'll say a few words about that. All right, so the Energy and Infrastructure Advisory team at JLL, we are financial advisors that support our clients in essentially doing transactions, raising capital, and some strategic consulting. So most of what we do is to run M&A transactions, either on the sell side or on the buy side, and we are extremely specialized in renewable energy assets. We are about 40 people in 6 different offices across Europe. You can see there. We have an office in Madrid covering the Iberian market, Spain and Portugal. We've completed hundreds of transactions, tens of billions of euros raised. So yeah, I think we're quite experienced and we know the market quite well. Especially we know the battery market. As a financial advisor, we are clearly the #1 financial advisor for battery storage transactions. As you can see in this chart, this is the number of transactions that we have closed in different jurisdictions since 2017, where we closed our first transaction. In total, we've done 38 transactions, and we have 10 at the moment, most of them in the UK, but we've also done transactions in Spain, in Italy, in Poland, and other jurisdictions. So I think we're quite experienced and we know this battery market quite well. If we focus on the Spanish market, just to set the context, this chart represents the targets set by the PNIEC, the national plan. On the left, we can see what we have at the moment. So around 8.3. Let me just see if I can change the okay. So we have around 8.3 gigawatts of storage facilities at the moment. Most of it is pumped hydro. These are the hydro targets. So the targets that were defined in the previous PNIEC, and this is the current PNIEC. So according to the current PNIEC, the government is targeting around 22 gigawatts by 2030, out of which we can estimate around 9 gigawatts of storage. So batteries, mostly standalone. So yeah, very ambitious targets. With regards to the regulation, again, we're not legal advisors, but we get this topic very often in the conversation. A lot of people believe that the regulation is not there, it's not in place. Actually, it is. There is a regulation that enables the BESS market in Spain. Of course, there is some minor tweaks here and there and some clarifications that need to be addressed. But that doesn't mean a battery can operate and can trade and can generate revenues in the Spanish market. So there is a regulation. The developers will say, and they are right, they're having difficulties because when it comes to going through the permitting process of battery projects, they do find challenges, especially with the local authorities, just because there isn't any experience in developing battery projects in Spain. People have never done it before. It's the first time for developers to do it, but it's also the first time for the local authorities, the regional authorities to go through the permitting process. So there are some challenges, but the regulation does exist. A different story maybe for the capacity market. So just to say a few words, there is a expected capacity market, and the word expected is quite important here, because everything seems to indicate that the government is actually working towards and supporting a future capacity market. Of course, this will be something that battery storage projects will be able to benefit from, other technologies as well, for sure. But it will definitely provide some, long-time secure revenues for battery storage. At the moment, I mean, the information is not very transparent, but going through conversations with a number of different market players, the associations, etc., what we know is that as of today, the process is kind of waiting for approval from EU, especially the Competition Director General, so DG Comp, and the Spanish MITECO, Spanish Ministry, has clearly said that they expect to publish a new draft regulation after the one they published, by the way, in April 2021. That was also subject to consultation. They expect to publish a new one, again subject to consultation, before the summer. But honestly, we don't expect any capacity auctions before, say, the first half of 2025. And maybe, starting operations in 2026. But again, there is a lot of uncertainty around the timelines of this capacity market. Now, of course, the capacity market will yield significant benefits for battery projects. Of course, the most important one is that we will provide the opportunity for these type of projects to secure long-term secure revenues. The levels are clearly to be seen, potentially for 10 years and potentially in the range between 20 to 50,000 euros per mega. But again, this is just a very broad estimation. It can be a lot higher, a lot lower than that. In any case, this will potentially improve the business case for many investors to make it more attractive in terms of financial returns, and it may facilitate non-recourse project finance because it will provide a base for financing. Nevertheless, the de-rating factors, which is an important parameter when we talk about capacity market, is expected to be higher in Spain compared to other European countries, as we have been observing over the last few years. But of course, as you know, there is more storage coming online into the Spanish market. These derating factors are expected to eventually decrease little and little in the future. But anyway, so the key message here is that there is a capacity market expected. The government is working on it, but significant uncertainty as to when this will be approved and operated. So market trends. So again, we as financial advisors spend quite a lot of time just talking to people, just having conversations and sharing market insights with a bunch of developers, both national and international, financing institutions, investors, funds, other advisors, technical advisors, market advisors, and of course the utilities, a lot of people. So we are actually in a good position to get what the temperature of the market is, if you will. So let me just highlight a few trends that we are observing on the development side, transactions and capital. So on development, we observe a significant development activity. So a lot of developers, they already started about 2 years ago, but now it's kind of everyone trying to develop battery projects, trying to secure grid access, trying to secure land plots suitable for these type of projects. And as I mentioned, of course, there are some permitting challenges due to the lack of experience, but the development process is ongoing, and we even expect some battery projects to get to the ready-to-build status sometime this year. So potentially some battery projects starting to connect as early as next year. In terms of transactions, that's our area of specialization, helping with transactions. We do see and are handling one of the first transactions in the market. And we are, again, seeing a lot of appetite from both national and international investors, especially many coming from the UK. UK is obviously the most mature and developed best market in Europe. And we're actually bringing a lot of our knowledge there since our colleagues have been working in battery storage transactions in the UK for the last 6 years. So we are, importing a lot of those investor names. And in terms of capital, again, equity is very eager and willing and happy to provide financing, DevEx financing, and as soon as there is ready-to-build projects in place, CapEx financing. So yeah, a lot of people is willing to invest equity. On the debt side, however, as we will see later on, we do see financing institutions and banks showing a lot of interest in understanding and analyzing this market, but they're not yet ready to deploy non-recourse financing. All right, the revenue stack. This is really the name of the game. So this is the biggest uncertainty, how a battery standalone especially, but also co-located, battery projects will generate revenues in the next 25, 30 years, 35 years in some business cases. What we can confidently say is that at the moment, according to the regulation that we have in place in Spain, there is 5 sources of revenues that battery projects can benefit from. And as we mentioned, the 6th one is the capacity market, which is expected. So here is a very visual summary of those 5 sources of revenue. Of course, wholesale market is one of the most important and clear ones. So essentially buying at low prices, storing the energy and selling at high prices. It can be in the day-ahead market, it can be in the intradays market, and it can be in the continuous market. But the nature of the market essentially is the same. Buying cheap, selling expensive. And then there is 4 different ancillary services that are available to battery projects in Spain. Secondary reserve or secondary band, tertiary replacement reserve, and technical restrictions. In the next slide, where I'm not going to go through all of these details, you can read it afterwards, we provide a high-level description of these sources of revenues. and a little bit of commentary. But again, I think you can read that on your own. Importantly, and this is one of the most important slides in my presentation, there is a lot of uncertainty. As you can imagine, it's very difficult to predict what those revenues are in the future. And we see this uncertainty as a three-dimensional uncertainty. So there is uncertainty in three different dimensions. The first one is the revenue level. So how much revenues will you, as a battery project, be able to generate in the next, say, 30 years? So we don't really know. There's a lot of uncertainty. In some cases, let's say, because this is gonna really determine what the return on investment will be for you in the business model. So again, there can be a downside case, base case, and upside case, which, as you can see, there are very different IRR returns. And by the way, all of these figures are just illustrative, so they're not real numbers. It's just to make the point that there is a lot of uncertainty. So the second dimension of this uncertainty is the revenue mix. And again, these are mock bar charts. But you can see here, some people, like player one, think that most of the revenue services will come from, most of the revenue stack will come from ancillary services, kind of the dark blue bar here. Whereas other people believe most of it will be in the capacity market. So again, what the mix of these revenue sources will be, it's also uncertain. And by the way, as of today, and we've seen this in real M&A processes that we've run, people have very different views. So some people say that most of the revenues will come from ancillary services. Some other people say that most of the revenues will come from the wholesale market. So again, a second dimension. And the third dimension is how all of these things will evolve into the future. As you know, these batteries will be there for quite some time, and we will talk about replacement and repowering in a second. But yeah, when you do the financial model, you have to consider, let's say, 30 years lifetime. So how these revenues will evolve in the next 30 years, it's also very uncertain. Again, we've sort of drawn up here base cases, downside case, and upside case, just as an illustration, just to let you know that this can evolve in very many different ways. Even more so, the revenue mix will also evolve over time. So maybe in the first few years, you have a lot of secondary market, and then as the time goes by, the wholesale market becomes more important, or even the capacity market becomes more important. So we don't really know. So again, a lot of uncertainty around BESS revenues. Again, we're not technical advisors, but we've been working on battery transactions in Spain for over a year, and we've come to learn a lot of things about these type of systems. I mean, it's not even a renewable energy system, because if you think about it, batteries do not generate any revenue. They extract, they do not generate any power. I mean, they take power from the grid, they store it, and then they release it to the grid. They provide different services. So they're not really power generating systems. So yeah, we wanted to just highlight three important ones that also have significant impact on the financial model, and hence on the profitability of these systems, of these storage systems. The first one is CapEx, which, by the way, is quite important also in the financial model. CapEx have been, again, up and down quite dramatically, especially driven by the cost of lithium, which is one of the key raw materials to build batteries. In this chart, we are just giving a bit of an indication of what the CapEx levels are and what their breakdowns are for batteries of 4 hours, 2 hours, and 1 hour. And we will talk about duration in a second. Importantly, as you can see, the 2-hour duration battery does not cost half of the 4-hour duration, unlike and similarly the 1 hour doesn't cost a quarter. So as you can see, there are significant decreases. So from 4 hours to 2 hours, about 40%, and about 60% to 1 hour. So that's one of the key insights. The other key insight is that, especially for the 4 hours, half of the capex is the batteries essentially. So yeah, I think, and these capex levels, by the way, these are from last year. You know, the market evolves quite quickly, so these may have already come down quite a bit in the last 4 months or so. One of the debates that we have found ourselves quite often into is the capacity of the batteries. As you know, best projects can be 1 hour, can be 2 hours, can be 4 hours, can be 8 hours. So it can be any kind of hours, right? And developers are often asking themselves, and sometimes they ask us, what's the sweet spot? And the sweet spot means to find the right balance between higher capex and higher level of revenues versus lower capex and lower revenues. So as you can see here in this chart, a 4 hours battery will cost more money, higher capex, but it will also be able to generate more revenues, and vice versa. 2 hours battery will cost less capex and will generate less revenues. So finding the right sweet spot between these different considerations is a bit of a challenge for a lot of people. It really depends a lot on what your revenue stack strategy will be in the future. And it also depends on your repowering strategy. What we are observing in the market is that most developers are actually going for 4 hours, which, by the way, also have an additional advantage in the permitting, which is the following. If you as a developer go through the permitting process for a 4 hours battery, you will need a little more space. Maybe environmental approval will be a little bit more difficult, etc. But then it will be a lot easier for you if you decide to do so once the project is nearing ready to build, to transition from 4 hours to 2 hours, so to reduce the capacity of your system. But if you want to do it the other way around, if you were to develop 2 hours and then want to go to 4 hours, from a permitting perspective, that would be a lot more difficult. So all in all, developers are rather trying to develop 4 hours batteries. Yeah, and then repowering. This is a big topic. As you know, batteries suffer from degradation whenever they're used. In fact, there is, I'm going to this circle at the bottom left, where we talk about degradation. There is 2 types of degradation, what we call calendar degradation, just because of the passage of time. Batteries, even if you are not using them, they will naturally suffer from degradation. But also there is cyclical degradation. So as the batteries are going through charging and discharging cycles, they will also suffer from degradation. And then there is different theories as to, or let's say not theory, but technical recommendations rather, especially from the manufacturers, as to when a battery needs to be replaced. So as they suffer degradation, their so-called state of health will decrease. So typically batteries are replaced or repowered when the batteries reach a 60 to 7% of a state of health. And there is 2 ways a system can be repowered. You can either revamp it or via revamping or via augmentation. So essentially revamping is removing all the old batteries and just putting a bunch of new cells. By the way, when we talk about revamping or augmentation, we're only changing the battery cells. Everything else, of course, can remain. So the power electronics will be still valid, so you don't have to change it. Same thing for the interconnection. Of course, same thing for all the civil works, all the auxiliary services. So it's only about the battery cells. So you can either remove them all together and put a bunch of new ones, which is called revamping, or you can do augmentation, which is essentially keep the old ones and add fresh battery cells, which is called augmentation. And then all of this also depends on your cycles. So depending on how many cycles per day or per year you're doing with your batteries, and by the way, this in turn depends on your revenue stack strategy. Of course, if you do more cycles, you will use the batteries more, they would suffer more degradation, you will have to replace them earlier. So all of these things are really interconnected. So a number of technical decisions need to be taken here, depending on what your revenue stack strategy is. And all of these, of course, have significant impact on the business case, on the profitability. And all of these things, by the way, have to be properly modeled in a financial model. And just to finish up, some considerations around financing. A lot of people is asking us, because of course we are financial experts, whether these batteries can be financed or not. And what we always say is that, like any other renewable energy project, there is some, let's say, requirements before any lender will provide non-recourse finance. The first one is contractor revenues, which is the one we don't have, and I'll speak to that in a second. And then there is a bunch of other requirements. Track record on the technology, I think we could say we have this because there is a lot of technical experience elsewhere in Europe, especially in the UK, but also in other jurisdictions outside Europe. Bankable and fixed price EPC contracts, I think we can tick that too. O&M and asset management contracts and contractors, sponsor, etc., and some risk control mechanisms. This is a little more doubtful, but let me not go into detail on this. But as I mentioned, contracted revenues is what we don't have in Spain at the moment. Other markets, especially in the UK, they do. And they do primarily through two different avenues, let's say. One is, as we mentioned, the capacity market. And the second is what we call the optimizer's floor. So as you know, I'm not sure if you're aware, but there is this player that will, in the UK at least, is called the optimizer. This is the party that will essentially operate your battery, will run the day-to-day operations of the battery, and will actually take continuous decisions as to whether to play in the secondary or the tertiary market, or technical restrictions, or play in the wholesale market. All of these, operational decisions that need to be taken on a daily basis, also live, will determine your revenue stack strategy and will determine your level of revenues. So the optimizer will typically charge you a percentage of the revenues generated by your battery. And some of these optimizers will give you a floor. So will give you a minimum revenue that they will be able to generate with your battery. And if they give you a floor, that will also make the project bankable. Now, just to share some market intelligence, these are, again, I'm not going to go into detail on this, but these are the financing terms that we are observing in the UK, which again is the most advanced, best market in Europe for non-recourse financing for BESS projects. So you have all the detail here. And just to finish up, all of these insights and more have been captured in a market report that we published in October last year, that everyone can download. It's absolutely free. So you can scan this QR code, you can click on the link there, or I can pass the link on the chat in this webinar. it's a very comprehensive report, a lot of market intelligence and data points there. Again, it's free for everyone to download. And then lastly, as I mentioned before, we are financial advisors. We can support you guys, especially developers and investors. If you're a developer and you have some projects or portfolios that you are thinking about disposing or finding an investor for, we're happy to support you in a sell-side role. We can help you raise capital or with your financial model. If you are an investor, likewise, we can help you to acquire some projects, consulting, etc. And that's it. Thank you very much for your attention. Right on time, Alejandro. So yeah, thank you.
Thank you very much, Tomás. Really interesting presentation on this really interesting topic. And thank you again for sharing this webinar with us. And we will start now the Q&A section of this webinar. And since we are already out of time, we will answer only a couple of questions. Uriol, I see that you have already selected a question. And Tomás, you have a lot of questions. If you can select one or two to answer in the time we have left.
Okay, so I will start. What impact has the February price fall had on PPA prices? So yeah, I mean, we make PPA price forecasting, and also we have our hub with our marketplace for off-takers and producers seeking for PPAs. So basically, in a scenario with falling spot prices for electricity, obvious the trend of the PPA prices is also decreasing, because basically the PPA prices tries to put value on the energy that will be derived. So if prices go down, PPA prices will also go down. Well, the situation is the one that in a downwards in decreasing prices scenario. So the producers now are pressing to close PPAs, and on the off-taker part, basically they are waiting, trying to see how much lower can the prices go.
Thank you, Uriel. Tomás, have you seen any interesting questions?
Yeah, there is quite a few. Let me see if I can answer some of them. So Christian was asking, explain the term non-recourse project finance. Non-recourse means that the lender, so whoever lends the money, will not take any guarantees to the borrower. The project itself will be the guarantee. So you don't have to provide a corporate guarantee or a personal guarantee to the lender. So the lender will not have any recourse on you, only relies on the revenues that are generated by the project itself, as opposed to the, let's say, the sponsor providing a guarantee. So if the project doesn't perform and doesn't generate enough cash flows to repay the debt, then the sponsor will have to pay instead. But of course, nobody wants to finance their project with a recourse to the sponsor. They want to keep the risk within the project under a non-recourse project finance scheme. I hope I answered that question. Then we also had a question from Dario regarding the Spanish capacity market, and he was asking whether it would be similar to the Italian MACSE. I'm not too familiar with the Italian MACSE, and we have experts in Italy as well. I'm happy to connect you with those. But from my understanding of the Italian program, it's not the same exactly, to be honest. It's quite different. Now, of course, we are waiting for the Spanish government to publish a new draft for the capacity market. So there is a lot of uncertainty as to exactly how it will be defined. But the way we understand it, and also based on the previous draft, it's essentially a market in which you will basically have your batteries project available in case the market operator, so Red Eléctrica, needs you to provide some services. And for that availability, they will pay you a fixed amount of money per megawatt. And maybe Oriol, you know more about this, so feel free to comment. But and that fixed amount of money will be subject to an auction. So participants in this capacity market will be able to place some bids. And of course, the lowest bids that fulfill all the technical criteria will win and will be able to benefit from those additional revenues in the capacity market.
Okay, perfect.
There
If
is,
you want to answer one more, yeah.
yeah. Then a question from Peter. What's the reason financial investors are not ready to invest in BESS? Well, I think they are ready, and maybe I didn't express myself correctly. I think we are seeing clearly a lot of appetite from financial investors to invest in BESS in Spain and even to take development risk. A different story is whether they will be able to take construction risk and CapEx risk, again, because of this uncertainty around future revenues. So some investors, and we know, and because we've been running some M&A process, and we know those investors, some investors are able and willing to build battery projects at the moment and take that financial risk on, investing the full CapEx to build the project. Some other financial investors are more hesitant because of this significant uncertainty around future revenues.
Okay, great. Thank you, Tomás. And we will answer the remaining questions directly by email. And as Uriol mentioned, I invite you to register to our next webinar in March that we will share again with EY. And thank you again, Uriol and Tomás, for your presentations and your answers, and the audience for joining. Have a nice day.
Thank you. Goodbye.
Thank you very much.